This video will help you understand the difference between withdrawing basis from your Roth IRA versus basis from your Roth 401k. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. Now, you might have heard, maybe from me, that you can withdraw the basis from your Roth account tax-free well before age 59 and a half. And while that is true, there's a difference between the ordering rules and how the IRS will code your distribution based on whether it's a Roth IRA or a Roth 401k, Roth 403b, etc. And so in today's video, we're going to break down the difference between these two to ultimately make you more informed if you were going to take a distribution. So let's jump in. Now, for those of you who are not super familiar, quick tidbits on the Roth IRA. It stands for Roth Individual Retirement Arrangement. It's ultimately an account you can set up whether you have access to a Roth 401k or not. And roughly speaking, about $7-8 grand a year can be put into this account if you make enough income. If you make too much income, you can't fund a Roth IRA. There's some ways around it, but just to keep it simple, it's an account that you fund all on your own. From an IRS pooling standpoint, whether you have 1 or 10 different Roth IRAs, the IRS is going to aggregate all of those Roth IRAs together. It's called aggregation, and the IRS would consider all of those Roth IRAs to be essentially one Roth IRA. We'll get into why that matters later on in the video. On the other hand, are Roth employer-sponsored plans, Roth 401ks, 403bs, etc. In a similar vein, these are also funded with after-tax dollars. You'll accumulate a basis in the account, which is what you've put into the account, and as opposed to the $7-8 grand limit based on your age for a Roth IRA, the limit on funding this type of account, based on what year you watch this, but in 2024, it's between 23 grand and $30,500 based on how old you are. One of the biggest differences with the Roth 401k, for example, is that there's no income limit. So just because you make $1 million doesn't mean you can't fund a Roth 401k. But if you make $1 million, you probably can't fund a Roth IRA. Now, not all employers offer a Roth component to their employer-sponsored plan. So you have to check with your plan documents, or at least, the employee handbook that breaks down, what retirement account options you have access to. One distinction though between Roth employer-sponsored plans and Roth IRAs, however, the IRS will pull all of your Roth IRAs together and make it one big Roth IRA, theoretically speaking, whereas with a Roth employer-sponsored plan, the IRS does not pool those accounts together. So if you've had 9 previous employers and you funded a Roth 401k with all of them, the IRS is going to look at all 9 of those accounts as different, and even the employer-sponsored plan you have access to today, if that's another Roth 401k, they're going to look at that account as totally separate. There's no aggregation that occurs within different Roth employer-sponsored plans. From a rolling over standpoint, other than your current employer, you can always move Roth 401k or 403b money into your Roth IRA. You can also move old Roth 401k and Roth 403b money into new Roth 401k or Roth 403b. For example, your old employer's Roth account to your new employer's Roth account, you can roll that stuff over. What you can't do, however, is you can't move money from a Roth IRA into a Roth employer-sponsored plan. Of course, you can go Roth IRA to Roth IRA, but essentially it is not permitted to move a Roth IRA into a Roth employer-sponsored plan. And I'll link below to the IRS's rollover chart that lets you kind of map this stuff out of ultimately what is and is not permitted. Now, regardless of which type of account, Roth IRA or Roth 401k, the IRS is going to break down your contributions into 3 categories. You're going to have basis, which is what you've put into the account, whether through a Roth IRA contribution or a salary deferral through the Roth 401k component. You're going to have a segment called conversions, which is money that's been Roth converted into those environments. And then lastly, you're going to have a segment called earnings. And that's essentially how much has your account grown by from your contributions and the conversions, what's remaining in the account. By definition, the full balance minus what you've converted minus what you've contributed is your earnings. Now, there's quite a bit of nuance here depending on which segment you are withdrawing from. A lot of it has to do with things called 5-year seasoning rules. I'll link above to some previous explainer videos on what that ultimately means, but to keep it super simple, with your Roth IRA, if you are going to make a withdrawal from a Roth IRA, the IRS is first going to code any distributions as coming from your basis or your contributions first. Once you've exhausted withdrawing all of that, then it's going to have you embark into conversion territory. And if there's no conversions, then you just immediately jump to the 3rd segment, which are withdrawing earnings. Now, again, watch some previous videos on 5-year seasonings, because that will dictate which of these components come with which types of taxes, whether income taxes or 10% early withdrawal penalty taxes. But the simple answer is the first dollars you pull out that are going to be coded as contributions, those are going to be completely tax-free, regardless of how old you are and how long money has seasoned inside the Roth IRA. This is in stark contrast to how a Roth 401k distribution will be coded. Again, you're going to have three potential segments. You're going to have contributions, conversions, and then earnings. But to keep it simple, the IRS does not allow you to first take out all the basis, then take out all the conversions, then take out all the earnings. The IRS essentially pulls everything together within the Roth 401k and has you take a pro-rated distribution, meaning any dollars you take out of a Roth 401k, whether you're under 59.5 or older than 59.5, is going to be considered a part of it being the contributions and then a part of it being everything else. To keep it super simple, if let's just say you had contributions and earnings in this account, and let's say 50% of the account is made up of money you put into the account, and the other 50% of the account is going to be made up of earnings inside that account. If you were to make a distribution from that account, even if the total dollar value doesn't exceed what you put in, the IRS is going to assume that you are proportionally taking from both segments of the account. That ultimately means 50% of that distribution would be from basis, and then 50% of that would be from earnings. Now, depending on your age and how long you've had this account, that's going to dictate the taxability of that. To keep it simple, generally the basis is all going to be completely tax-free, but the earnings portion is going to come with some taxes. Now, of course, I'm probably going to be referring to old Roth 401k accounts you have if you're going to, pull the trigger on pulling some money out, because existing Roth 401k money, you'd probably have to meet some type of in-service distribution rules that your employer has. If not, maybe the rule of 55. It's going to be employer plan dependent on when you can actually pull money out that way. But theoretically, if you were to take a distribution from like an old Roth 401k, the IRS is essentially going to prorate your distribution as being a combination of basis and a combination of earnings. So does that mean you should just roll everything into a Roth IRA so you can pull the basis out only? Well, not necessarily. We'll touch on whether or not we should do that later on in the video, or you can skip ahead to this next segment. For a quick example, let's walk through a hypothetical Roth 401k. Let's say that Roth 401k has 100 grand in it. And what makes up that total 100 grand is you've put in 70 grand and the account's grown by 30 grand. That essentially just means any money you pull out of that account, 70% is going to be considered tax-free basis, and 30% is going to be considered income taxable. And the easy way you do that is you just divide the basis by the entire account balance, which in this case is just 70 grand divided by 100 grand, which is 70%. Which means 70% of your distribution will be considered coming from basis. And the remaining 30% is just going to be considered earnings, which may or may not come with certain taxes. Again, watch my 5-year seasoning rule to get a better understanding there. So one question I do get a lot is, how do I track my basis in each one of these types of accounts? Roth IRAs and Roth 401ks, for example. Well, we'll start with Roth 401ks because I think that's the easiest. Generally, on the investment statement, you will see basis, and then you'll see a total account balance in the Roth 401k. Theoretically, if you didn't see basis listed anywhere, then you could simply look at year-to-date contributions into the Roth account, and then you could easily deduce if my account balance in the Roth is 100 grand and I've put in 40 grand, well then by definition, the remainder is earnings. Now, if you've done conversions into the Roth 401k, that kind of muddies things up a little bit, but theoretically, you could just look at year-to-date contributions and understand that's my basis. Now, you have to do that for every single year you've had this Roth 401k, but most investment custodians out there have an online portal, and you can easily log in and see past year, December 31st statements to surmise what your basis is inside the Roth 401k. Now, once you start moving Roth 401ks around to different places or moving Roth 401k to Roth IRAs, it gets a little bit complicated. Of course, you could just wait after doing a rollover for the 5-year seasoning rules to all elapse. Then you don't really have to worry about it. But theoretically, once you start moving things around, it could totally get lost in the sauce what your basis is versus the earnings. Now, Roth IRAs, on the other hand, there's actually no obligation for the investment custodian to track your basis in this account. Of course, if you work with an advisor or a team, they should be able to easily tell you, here's how much you've put into this Roth IRA since you've been working with us. Every year, you'll ideally get a tax form called a Form 5498. That's just an informational tax document. You don't need to include it on your return because it already goes to the IRS, whereby it tells you here's exactly how much money was put into this Roth IRA, whether through a contribution or a conversion. If you did a conversion, you'll get a 1099-R, and that basically says here's how much money came out of this other IRA and went into this Roth IRA. But unfortunately, your Roth IRA basis is not plugged into your tax return anywhere. You'll have to just figure it out through 5498s or asking your advisor for a history of contributions. Okay, so the question you might be wondering is, should I roll my Roth 401ks all into my Roth IRA to keep things simple, and then parse out basis, conversions, and then earnings, so that any distribution I make will first and foremost, for sure, come from the basis first. Well, generally, I'm a huge fan of account consolidation, but there are some reasons why you might not want to roll money from a Roth 401k to a Roth IRA. I'll link above to a previous video that outlines some pros and cons as to whether or not you should roll money around where. First and foremost, I'm a huge fan of consolidation. I think it makes it easier on people. There's no concern for required minimum distributions anymore from Roth 401ks. A few years ago, Roth IRAs didn't have RMDs. Roth 401ks still, for some reason, had RMDs, but that's no longer the case. No Roth accounts have RMDs. When you're retired, though, generally, I would say yes, life is just way easier when you have one account to worry about, even if there are no longer required minimum distributions inside those Roth accounts. And of course, there might be features in like the Roth 401k that make them attractive, of like low fees and simplified investment selection, whatever. However, if you ultimately want to make distributions from all your Roth accounts and you only want to take out basis, you can't do that in your Roth 401k, so that's a good reason to consolidate into a Roth IRA. Okay, so from a calls to action standpoint, the only one I would have for you is find a way to track your basis and at least kind of know generally what ballpark you're in if ever you're thinking about doing a distribution. I would not just willy-nilly jump into pulling money out of a Roth account because you heard you could pull the basis out tax-free. I would get some documentation behind you to ultimately back up if the IRS ever comes knocking. You have a paper trail that says, no, I put in 20 grand into this Roth account, specifically this Roth IRA, so my 20 grand distribution is all basis. Likewise, with a Roth 401k, I would look to make sure you have some documentation that says I put in 20 grand into the Roth 401k, so my distribution, though a portion will be earnings because it's all prorated, here's how much should have been tax-free. So hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your day. We'll talk to you later. Bye.